All right, so welcome into the live stream today. We're going to be diving into the markets, a lot of the macros that really affect all financial markets. And I thought, this is a time where we actually want to bring in some financial advisors on this side of things and dive in a little deeper. My name is Paul Barron. Welcome back into TechPath. Hey, joining me today is an old friend of the network, and that is Mr. Andrew Horowitz with Horowitz and Company. Great to have you back.
Hey, Paul, how are you?
I'm great.
Well, I want to wear my black shirt to match you. The hip hop and Paul, and just always looking sharp.
Well, listen, we have to keep it up here, So, hey, listen, Andrew, let's get into it today. Talking about obviously nothing really to laugh about. With you kind of have to look at the situation and hopefully have a good attitude toward all of what's happening in the markets. But let's jump into first of all, just to kind of give our audience, because you haven't been on our show in a while, a little bit about what you do and kind of your structure, where you're at in the financial ecosystem.
Yep. So I run a money management firm. We actually are investment advisors, and what we do is we manage money for people that want to have the expert advice in different areas of their portfolio. So we have a range of things from an asset allocation, more traditional, to the more, I would say, aggressive side of trading, individual equities, et cetera. So it runs the gamut. So I do a lot of work, just to set the stage in what we're talking about. I do a lot of work in the area of economics, which for a while hadn't been as important, because when we had the massive stimulus that we saw the last couple of years and low rates, it was all about the Fed, which it is today to a bit as well. But what we want to do is we want to understand fundamentals, where the values are, where the opportunities are. So we're trying to position, whether it's in international, do we want to be in hedged or unhedged in terms of dollar? Do we want to be in domestic, large cap or small cap? Do we want to be in technology versus healthcare versus banks and utilities? So there's a variety of different things that we're looking at all the time to make sure that we can position ourselves as best as possible. So that gives you the groundwork of what I do on a daily basis.
And I've followed you and your podcast for quite some time. For those listening in on the live today or watching this in post, make sure and check out The Disciplined Investor. Andrew does a great show there. It's one of the oldest financial podcasts out there. I think it is the oldest financial podcast.
The oldest, the longest running since 2007. When I was asked by my publisher, when I was writing my first book, The Disciplined Investor, with the same name as the podcast, they said to me, hey, why don't you think about a great way of marketing would be to do a podcast? And I said, what the hell is a podcast?
That was when there was 9 people listening, I think.
Right. It wasn't a big audience, but it was fun. I mean, I got to fly out to Cupertino, and I worked with the Apple group at the time in the iTunes division. And we were, they were in their infancy. We were setting this whole thing up, met a lot of great people that are still around in the area. It was a lot of fun.
I think a lot of people don't understand we should probably do a show one day on just media and how distribution works and how communication has really kind of changed a lot in the financial markets. Because I think now more than ever, an average person can really learn and educate themselves tremendously in preparation for a market, to a point where they can get to a situation where they can afford a money manager. So all that good stuff. Let's get into really the topic of today, and that is a lot of blood in the water. When you look at traditional markets, obviously we talk a lot about crypto, digital assets, and kind of Web3 and where the future of tech is going. But let's go into the Fed first. And we have FOMC today. We'll be doing a live stream. Make sure everybody listening in, watch for our live stream later. We'll be streaming Powell and kind of doing some commentary on that. So catching into that. But Andrew, do you think we will see the expected, some people pointing at the 0.75 basis points on the hike?
So the Fed is really reluctant ever to do something that would spook markets, surprise markets, really offside markets. And when I say markets, it's the gamut of financial and risk assets, right? And investors. And up until last week, there was about a 30% chance of this meeting at 2 o'clock on Wednesday, on the 15th of June, that there was going to be a 75 basis point hike. And that was because Powell himself said in the last meeting, you know what, we're really not considering this right now. And the idea was there was going to be a series of 0.5 or 0.5% rate hikes that was going to be putting a crimp on the economy and slowing down the velocity of money in a way that would hopefully do something with inflation, because they're freaking out about inflation. So an 8.6% print last week on CPI, we see 11.5% or 10.5%, depending on what the core versus what's in or out. On PPI this week, Those are hot numbers, and we all know it. We all know that we're going to the gas station, we're paying more. We know I had an experience that I went to buy chicken. I went to buy chicken a few weeks ago, and I saw all these people just standing and staring. I'm like, what is going on at the chicken counter? I got there and I was standing and staring too. I'm like, that cannot be the right price. And these are the things that they're trying to slow down, because inflation and runaway inflation is very destructive to an economy. Not as bad as deflation, very hardcore. But
Right.
the answer to your question is this. 2 days ago, there was a Wall Street Journal 3 p.m. trial balloon that was floated, or a Fed whisperer wrote a piece that hinted that there could be a 75 basis point increase, 0.3% increase on the rate today. That is a clear sign that the Fed is getting us ready for that. The rate probability in the Fed fund futures jumped to 92% right after that. I think it's pretty baked in. Jeffrey Gundlach from Double Line is saying that the Fed should push it and raise it to 3% today. We got Jeremy Siegel saying 1%, Kramer saying 1%. The Fed's not going to go nuts. I don't see any reason. But I think 0.75% is baked in, especially due to the fact that we saw the emergency meeting called for in the EU today, because they're just getting pummeled on their fixed income. So I think it's pretty baked in, at least 75 basis point.
Okay, so it's what we've kind of been talking about for a while now, looking at this kind of especially in our situation from a crypto or digital asset side, we've seen just ridiculous lows. Crypto has not seen these kind of numbers really ever, if you even look back at the 2017 bull run. But if you look at the potential here for a full point, and just hear me out on this, if you've got, again, a secondary print on CPI numbers going positive, the likelihood is we're probably not slowing down. And that's not really the real number, let's be honest. Food and fuel is going to take us maybe closer to a double-digit number if we were really looking at numbers here that were accurate. First of all, can 1% could that pressure the market and put us in a position where we could see a very, very adverse reaction from markets in general?
I think we've seen that already. I think the markets are prepared. We saw a 4% day this week. We see that the NASDAQ's down 33% on average for the stocks in the NASDAQ. And that's what the market cap weighted. The underlying stocks down 70, 80% all over the place. However, here's the deal that we all need to kind of come to grips with. The Fed raising 0.5%, 0.75%, 1%, 2% is going to do nothing for areas of the market that they have no control over. The idea that food costs will come down, listen, chicken prices, when I just told you about my standing and staring, the chicken prices at that point were up due to a major cull due to bird flu. We have corn and wheat prices that are skyrocketing due to the fact that they are a lot to do with the Ukrainian area, which are major exporters, and Egypt has cut down exports of that. Fertilizer prices have gone up dramatically. Where do we get our fertilizer from? We get it from places like Belarus and Russia. Hello, not a good place to be getting things from if we want to have it at a reasonable price or get it at all. Therefore, if prices are up on fertilizer, the soybean farmer is saying, maybe I'm not going to plant as much this year or not use as much fertilizer. I'm going to plant, but I'm not going to use fertilizer. Therefore, his crop output is going to be low. Therefore, prices are higher because supply demand. The idea that the Fed could increase rates by 1%, and that will somehow do something to the natural gas flow and LNG to Europe is just ridiculous. They have no control unless they go full Volcker. For those of you who are over the age of 45, that remember the days when Paul Volcker crushed the economy and put us into a major tailspin. If they're going to do that, fine. But otherwise, there's no way that we're going to have the interest rate hikes that will allow for inflation traditionally to drop so substantially. The last thing I'm going to say on this point is, even if we do get inflation to come in a bit, prices are sticky. Inflation is transitory, it always is, depending on the time frame that you look at, right? That's why the Fed said that. They thought they can get away with it. The problem is it's gone on a lot longer than they anticipated. Even if inflation from now for the next 10 years is 0%, prices are not going to drop. Does that make sense?
Yeah. Well, yeah, and that's something that we're continuing to watch. As many of you guys know, we run all other networks here. We have our financial side and our crypto side, our tech side. We also track a lot in the food side, which we track what's happening in the food side
Sure.
in these trailing indicators. The trailing indicators on
Yeah.
food and fuel, when you think about that being the two contributors to where pricing is really being pushed. With that, all that being said, Andrew, if you don't feel like a pressure on interest obviously is going to slow the markets down, we're going to see real estate obviously take a hit, crypto will take a hit, traditional markets will take a hit, bonds and yields will take a hit. Why would the Fed be going in this direction if we don't see a true implication on slowing the actual inflation numbers down for the average person?
They're idiots. Let's just get it out there, okay? They're idiots. If you've listened to me for any time, you know that I've been absolutely just. We even do on DH Unplugged. We have a segment that's called Fed limericks to make fun
Yeah.
of the ridiculousness about what they are. They become very political, but even put that aside. Let's not even bring that up because their antennas will raise about the politics. They're just way behind the curve. They have always created booms and busts. They've always let it go too long. They didn't see the 2008 crisis coming.
Yeah.
Who didn't see that? They didn't
Yeah.
see that inflation would be more than transitory. I mean, just unbelievable. They let it go for too long. Remember, they have portfolios. They have assets. They have equities. They like to see their portfolios go up as well, too. We saw that recently with the fact that the two guys that were asked to leave because they were trading on
Yep.
data of inside data. And they say, oh, no, nothing's going to happen. The thing, Paul, is listen, the Fed is all they are is a confidence machine. They're cheerleaders. Really, that's what they are. All they can control is the confidence in the markets. Everybody's lost confidence in the Fed because they're so far behind. They allowed for interest rates to be low for too long in the face of what happened with $9 trillion worth, or whatever the number is, of stimulus that came into the markets. There was a lot of free money. And then all of a sudden, someone turned off the faucet. We have no more stimulus coming. Quantitative easing has stopped and actually going to quantitative tightening. And on a much lesser scale, with regard to crypto, for example, why did crypto go up? There was great confidence. There was the opportunity for low interest rates. And more importantly than anything was the free money. And that's why not only crypto, but the SPACs and the projects in the vernacular of crypto, the projects in the area of equities, right? I'm talking about companies now. We'll call them projects too. Those projects that were never going to come out and make money. They had a path to profitability, but they weren't profitable. Were allowed, the Lyfts, the Ubers were allowed to continue without profits because who cares? They keep on getting free money.
Yeah.
The private equity, the venture capital, it's all being destroyed right now because there's no free capital.
Yeah, you're on a rant. I feel your pain. I feel your pain here, Andrew. These are the kind of conversations we have offline all the time. Hey, I want to show you a tweet here by Peter Brandt. This is an interesting one.
Yep.
Fed has never in modern back to your point, history been so far behind the curve. Embarrassing. Not only did the Fed create the mess, they're also way behind the curve in fixing it. Solution. This is crazy. 400 basis points. Let the stock market collapse. Hit reset.
I mean,
what do you think?
Yeah. I don't know. I mean, what's
That's
the point
crazy.
of the whole? First of all, why do you have to bring the stock market in there? Which tells me that his book is short. It tells me that he's probably has some heavy VIX options. He has some short positioning on. He wants this to happen. I mean, nobody in their right mind wants a stock. Why would anybody want a stock market to collapse unless it's just not a good thing for mankind. You don't need this happening, sending the world's financial systems in disarray. So I would venture to say he's probably been talking this way for some time. He probably got his ass kicked over the years being short. And now finally he's going to get his, last licks here on the downside.
Yeah.
But that's
what do you think
a little
about,
ridiculous.
Yeah. What do you think about Biden actually kind of realizing, hey, wait a minute, I'm losing money in the stock market. What's going on here? What do you think about this?
Biden said that?
Yeah.
Oh, really? Yeah. Well, I mean, he doesn't have a big portfolio anyway, or he didn't have a big portfolio. He's not one of the richest men ever to come into the presidency, but he's got money, I guess, just like everybody else. They will get dinged and eventually they will look at their thing. But I mean, he's still got a retirement that's set for the rest of his life. I don't know how much he's going to really care about this. That is the case, though, I think, with the Fed. That's why they've been so reluctant to really do anything crazy. And think about it. A 1% interest rate hike that we've had recently has basically evaporated trillions of dollars worth of wealth.
Exactly.
Again, that's not good for anybody.
How do you see this? All right, so let's play this out in the next 2 quarters. We're going to continue to see CPI numbers rise. The question will be how much hocus pocus can be pushed into that CPI calculation to
Right.
keep us,
Right.
at bay, the barbarians at the gate somewhat.
Yep.
We see this into Q4. What are your anticipations for Q3, Q4 before we roll out? Are we going to see more pain in traditional markets through the end of the year?
So I think that markets are already pricing in somewhere about 1.5% more of increases by the end of the year, give or take, depending on what happens.
Mhm.
I'm still of the camp that if you do a few things, like if China comes back online, because they're a big problem right now with the supply
Right.
chain, there's a push and a pull, right? The potential for an increase in usage of oil, energy would be higher, but we would release a lot of pressure on the supply chain. If we can get beyond this war, which I'm having a lot of difficulty understanding the point of all this, except for megalomaniac, crazy man is desirous of a last
Yeah.
stand or something.
Yeah.
There's nothing really there to take, right? So if we can get beyond this war, that would be a huge relief to the markets. I do think that we are going to reach a critical point where the Fed is going to choke off, and already happening, things like mortgage applications down 50% over the
Yep.
last year. While Zillow still has your house at an all-time high, I'm sure. And I've looked at mine recently. I'm like, how is that even right?
Yeah.
But the fact is that you have a 6.5% 30-year mortgage compared to a 3.5 or so at the beginning of the year. That is a big deterrent from buying a house at those prices. So housing prices will adjust, just like stock prices have adjusted with interest rates. So you're going to see a lot of wealth effect evaporate. And I think that is going to be deflationary
Yeah.
or not inflationary, right? It's not going
Yeah.
to be there. And I already seeing, you've probably noticed this, and you can track this on the private side, in the crypto space, in the areas of technology. A lot of layoffs are starting to happen.
Sure.
A little 1,000 here,
Yeah. Well,
2,000 there.
yeah, definitely. I mean, the crypto side, we've got mass layoffs in, I would say, all the top tier companies that were kind of overbuilt, with exception of Binance, which is actually kind of doubling down. They're looking to try to grow. But interestingly enough, I was looking at some of the research we were tracking on these layoffs, that actually traditional banks are looking to start grabbing these Web3 guys, all these devs. So that tells me there's a lot of potential future there for where blockchain is going to be going if we do see digital assets make it into traditional banks. Regulation coming maybe with Senator, or with Lummis and Gillibrand's new potential bill, that obviously we'll see a lot of adjustments there. But you didn't answer the question. End of year. What are you thinking? By end of year, do we see the bottom, and are we going to start to see correction at that time, or do you think we're going to roll into a recession towards 23?
So I guess there's so many outcomes right now, and that's why I'll try my best. Do not hold me to the absolute here, because we didn't think there's going to be a war start at the beginning of the year, which kind of threw things into a twist. My best guess at what is going on right now is that we're going to see another quarter of just gyrations and problems. And I think if in fact we can stabilize some of these pricing, we're going to actually have a better, I would say back half, but fourth quarter.
So you're feeling a little bit kind of a swoop off the bottom, maybe.
Yeah, I think that, we're seeing this 22% from the high on the S&P 500. Really, the most of the problems have happened in the smaller stocks, and there's opportunity in many of these. And I think there's just a bad karma around all of them. People are like, oh, the hell with this. I'm out of this. They're never going to make money again. It's like, wait a minute. These companies are making, a lot of companies making money. They're down 65%. Their earnings ratios have come down. I will share this with you, that in my screening on one of our strategies, we have more stocks in there that have made the grade, made the cut, than ever before. How is that?
Yeah.
High margins, consistent revenue. There's still a lot of good happening in the economy. Just everybody's running outside with their hair on fire, freaking out.
Yeah. All right. So maybe a little bit of overreaction, because to your point,
I think there's some overreaction. Yes.
Yeah. So with what, and I almost wonder about this, because this is something that I've talked about before, is, are we listening to the Fed too much? In essence, it feels, I know from the crypto side of things, if you look around, the crypto influencers, YouTubers, news, you name it, everybody is waiting for that FOMC meeting, every single FOMC meeting. And it's like with bated breath. And if we're at a point where We just have to look at the Fed that are basically gatekeepers in the essence, and we have to really look at the structure of how the global macros are affecting so many things, whether it's food, fuel, the issue with obviously global conflict, China playing into this. We've talked about that many times on the show. So definitely from my point, we still see this as a lagging indicator around pricing. This is because if you look at retail, and the restaurant industry is one of the biggest retail sectors out there. I study it a lot. And we're seeing for the first time double-digit down numbers on traffic. So obviously that's going to only put more pressure on either for them to correct pricing, because there's been a lot of lifts in retail food pricing, which has also indicated some big issues there. All right, so when you look at, and just for everybody, make sure and jump your questions into the sidebar. We'll try to get to some of those, and make sure
Can I
and hit
just
like.
can I pull back on something there that you were talking
Yeah,
about?
for sure.
I think the issue with crypto right now, there's multitude of issues with crypto, but you know what? There's one thing, and I talked about this last night on a show. There's one thing you just don't do in financial markets. It's rule number one, and that is never tell someone they can't get their money. And when you have a situation like the collapse of Terra and Luna, and then the concern about stable coins, and then all of a sudden that flows into what happened with Celsius, and that's just not cool. Now all of a sudden, somebody who has, pick your coin over at Coinbase, right, or at Robinhood, or pick your whatever, but let's say Coinbase. Now all of a sudden you're thinking, could that happen to Coinbase?
Yeah.
Now you say, well, it's not the same thing. Celsius, who, if you look at the person that designed, the 24, 25, 26-year-old designed the massive leveraging that went on with that, and it was all about leverage, right? That's how you get your 15% just by depositing your money there, because that's a safe thing, right? Getting 15% for doing nothing. I've seen these before, and that's what's happening right now. Well, if you don't have the leverage and all, and people are starting to think, well, what's the backing of this? That's what's happening, I think, right now. People are saying, the hell with this. I don't want to put my stuff on a drive. I'm just out of this. I'm done with this. If it can happen at Celsius, which is, they had a nice website. They had a great app. That's all you need these days, right? It's pretty. And maybe some confetti. So what happened is that I think a lot of people are getting blindsided by this. And the reality is it overvalued? Is it undervalued? Is Ether or Bitcoin? I think it's all a matter of, they're telling people that they can't have their money, and people are freaking out.
Right. Yeah, which I think is one of the big factors here, is that, we try to calm, at least our audience down quite a bit, in the sense of, listen, these are ebbs and flows of market. If you haven't been in markets for long, whether it's traditional markets, and you've invested in stocks, maybe you've got into bonds, whatever it might be, these kind of things come and go. And if anything, they're opportunities for the future, because obviously the economy and the United States, as well as the global economy, is not stopping. It's not as if we're just going to say, hey, everything's off and we're heading back to sticks and stones here. This is just one of those eras in time that many people have not lived through. A lot of these millennials have never lived through 2008, never lived through 1980. They hadn't seen those things. So it's a bit of a slap in the face. These kind of things do hit the markets. The key there, obviously, is longevity and staying with the blue chips, whatever layer you're in, staying with the blue chips.
Blue chips something, right, whatever that, or the high-quality names with good long-term fundamentals that can weather the storm. You want a boat like a Boston whaler right now that if you could cut it in half, it still floats. That's the point.
I didn't know a whaler would float if you cut it.
Yes, a Boston whaler, you cut it right in half, it still floats.
Well, you're a boatman, so you know these things. Yeah. All right, Andrew, let's get into when you think about 2023, because I want to kind of move on. We're here at halfway point. Fed's still putting pressure on the market. We've got obviously issues with pricing. Most likely, we're going to see some labor issues toward Q4. Labor issues are the one thing that we have not had as an intricacy of adding to this mess. We've seen global conflict, we've seen inflation, we've seen ridiculous market corrections, but labor has not necessarily been on point. Now we run into labor in Q4, Q1. What does that do to mid-year for 2023?
I mean, you're talking about the potential for layoffs and all that, right? Is that what you're talking about?
Yes. Yep.
Yeah. So the problem right now is unfortunately, one of the things that's going to happen, and the easiest thing to protect profitability in a company, is to lay people off, especially due to the fact that we had this push, because everybody should make more money no matter how good they are or bad they are. We just have to make wages go up, right? That was the mantra over the last however long. So now all of a sudden companies were forced into, and some people were underpaid, of course. So there was, an adjustment that was made. That's good. But the problem is business. And, we're not Japan where you got a job and you can be in a corner and just do nothing and you still have a job 30 years later. We are the United States. We're capitalist. And what happens is when you have a situation where companies need to cut, they're going to find places to cut. And that's what we're seeing. And they're going to cut advertising. That's why the advertising space is hurting. Crypto is one of the biggest advertisers, by the way, for a long time on podcasts. There's like ghost town out there right now.
Yeah,
so
for sure.
The adjustment is going to be important to recognize, especially if we have people that are on a pay scale that was raised recently. Therefore, the take back is going to have to be that much higher. And, on one hand, we don't want inflation, but we want our income to go up, right? I mean, how does that work? Somebody's got to pay for it. So if I'm working at McDonald's and everybody gets a 10% raise in pay, I would think that McDonald's probably is going to raise the price of burgers by 10% as well to get their profitability.
Yeah, and pricing is definitely baked in for sure, based on adjustments of labor. The question obviously we'll see right now is if we do see labor hits towards the end of the year, early next year. Obviously, companies are going to adjust to this. This is kind of that macro that we have to worry about, which obviously begs the question: is that when we see the real recession? Obviously, by the book definition, we're probably already there.
Correct.
But really seeing that from an aspect of the markets, when do you think that might be? Q1?
What they say is a recession is when you're out of a job. A depression is when I'm out of a job, right?
Yeah.
When I look outside to others and what they're doing, not just me, I mean, everybody. I think, yes, you're going to have, recessions are okay, by the way. I want to tell your audience something. Come closer. Recessions are okay. It's part of the process. If you don't have a recession, the problem is that you're never going to have the opportunity to rebuild and grow and get rid of some of the excess. It's like a forest. If you have a forest that continually grows out of control and is not cut back, weeded, or maybe even a fire to destroy and rebuild, it's going to become a just absolute mess. And one day it's going to become really disastrous. So recessions are part of the economic cycle. The question is how deep and how long lasting is it? Just like when we have the upside. So I think we're going to have a shallow recession if we can get some of this under control, right? I mean, there's a lot of variables. I can't control China's COVID zero policy, right? I can't control whether or not Putin decides, Finland is looking like ripe for the taking. I mean, we can't control the North Korea, or NOCO as we're calling it these days, if they're going to be really rebuilding in Iran their Iranian enrichment programs to create weapons. So there's a lot of things that are headwinds right now. And obviously, I can't control the stupidity of this administration's moves on their energy policies and all of their green processes without a good plan and their attack on corporate America. So all that being said, I think we're in for a lot of difficulty here, but I don't think it's insurmountable. I do think you're right. There's going to be a recession that will dovetail with jobs. And I know I'm a little bit long-winded here, but I think it's important to educate, right? I think it's important to flush this out so everybody understands it's going to be a tough road. It is time to tighten your belt before things go awry. And if things don't, you know what? You're doing fine anyway. So, but that will lead itself, I think, into, where are we, June? So yes, fourth quarter, first quarter of next year is when approximately we're going to probably see more layoffs. But again, that doesn't mean it has to be a bad thing. Profitability of companies can actually go up and markets can actually do well under those circumstances.
Yeah, and I think that's something we are analyzing very closely with, at least on the crypto side, because there's a lot of very early stage companies that if you look back, they kind of have a lot of similarities to the dot-bomb era. Very fragile, but also great opportunities. You just have to pick the right pony to ride out of that gate when it does open. So there's some really cool stuff. Hey, listen, we're going to get to some questions, but before we do that, I want to show a poll that the audience just responded to. Let's take a look. All right, so 500 votes on this one. What asset are you looking more worried about? Crypto market, obviously. Stock, quite a bit less. Neither. And both equally. So crypto, obviously, for our audience, which is a large part of digital assets in crypto, so for sure. Let's get into some questions here. When is the next BTC happening again? That's 2024. First crypto winter due to watching and listening to the right people. And everybody's bracing. So when was the last time on the stock market you've really seen a correction like this?
The 4 days in March of 2020 before the government stepped in and just flushed everything with money. There have been a couple of taper tantrums and other, like 2018, there was some. This one is, I don't want to say different. Well, it's different. I would say it's different because it's shifted.
Yeah.
Right now we have energy leading really nicely, but yet a lot of the technology is getting killed. The companies without any earnings potential are just getting evaporated. Some of the EV names that were like, oh, how exciting is that? Are just like, what happened there? It's not exciting anymore, right? Because they're running out of opportunity. They're running out of, they're basically, if they were a plane on a runway, they're running out of runway before they crash and burn without any more money. And a lot of people are like, I don't have any more money to give you, or I don't want to give you any more money because by now you should have been profitable, which is, I don't know about you, but aren't companies supposed to be profitable eventually?
Well, yeah, I think that is, I just spoke at a conference on this very topic, is that we actually might be seeing a period in time in which we were right at the brink of potential innovation breakthroughs. And then this happened. So for instance, EVs, the likelihood is that Tesla is going to be the only survivor, most likely, that comes out of this thing. If you look at crypto, there's only going to be a handful of exchanges and potential real good projects that truly make through. But there were probably and are several innovative projects and technologies that are going to get squashed. This happened in .bomb. It's just like a
or bought up. Right.
Maybe,
I mean, if for some reason Sushi Coin is actually the leader of all coins, eventually it will come out somehow in the process, don't you think?
Well, yeah, Sushi Swap I don't think would be, but there is a Sushi Coin.
I know. I'm just saying. I'm saying, right?
Nobody talking about the November elections. What do you think in midterms? You think obviously this is going to be a train wreck for the Dems. We've got all kinds of craziness happening.
Yeah.
Do you think markets they're trying to adjust to market prep for midterms in November?
So one of the greatest things that can happen in markets is gridlock, right? Markets love gridlock. Why? Because Congress isn't doing anything. Because when Congress is all on one-sided, it can be good or bad. But usually we don't want Congress involved in making decisions because I think along with the Fed, they're not the brightest group of people when you put them all together. They make a lot of bad decisions and it's all based on what they want and it's not good. So my hope is we will go back to gridlock and get out of, this ridiculous mode of pandering to, things like green energy, which is fine. I'm all in favor of all, and I love it. Right. It's great. But could we please do it with a plan, so that we don't have these problems, closing off pipelines, exactly. Shutting down, It's just stupid. Do it on a plan.
Well,
do it on a plan. Maybe 5 years.
Look at Europe. Look at Europe. I mean, shutting down nuclear, and now they're in this position that they're in right now with obviously
how crazy.
Gas. So another one. Michael K. Some big macroeconomists saying just the beginning. There will be years of inflation and rate hikes. Some say too far. QE is possible. What do you think about that, Andrew? Do you think it's just the beginning, or
there's too much? You have to look at the whole situation around the world. There was a huge amount of assets that are on the books in this. I think it was an experiment. It was great. You know what? Hey, we got COVID. Everybody's locked down. Everybody's going to need money. Let's do an MMT experiment. What the hell? If there's any time to do MMT, monetary theory, it's now, right? Which I never thought was a good idea. But we could build our bonds. But the problem is you got trillions of dollars of bonds on the books of central banks. They can't raise rates forever. It's going to be very destructive because governments won't be able to borrow, which is how they run their governments, right? There's no equity in the government, is there? They don't sell equity. They don't sell shares. It's all based on debt. So there's so far you can go with this until you have a real problem, because also companies and individuals, even though balance sheets of companies are better and individuals' balance sheets are really much better than they've been pretty much ever over the last number of years that they did well. I don't think that we can have rate hikes forever. I don't think we'll see a 10%. I don't think we're going to see a 10% rate on. It's not like you're going to be able to go to the bank and get a 14% CD anytime soon again.
Yeah, for sure. Here's another one. What happens if, and this is a more of a question I think that applies to all markets. What happens if a major like a BlackRock comes in and says, "Hey, I'm going to buy up a lot of stuff." BlackRock's already buying up real estate like crazy. They could come in, and from your opinion, when markets are this suppressed, the big boys that do have liquid assets on the sidelines, trillions and trillions of dollars at play, that could come in and just swipe the entire market, all markets, crypto, traditional stocks, you name it,
Sure.
real estate. Are we at that kind of risk of a complete, pretty much detachment from the middle class away from ever making it into this space?
I mean, I think that they will do it. BlackRock's big. I mean, look, Larry Fink and those guys. I mean, they have BlackRock has a huge position in the markets. There is the only thing they want to do is be supportive of that so they can get more fees going on for the future. You know, they again want to keep confidence up. So I don't think that's a negative issue if they come in supportive. I don't think they got the wink yet from the administration to you know what, have you thought about maybe you know,
jumping in here,
the plunge protection team doing something there. So I think that you know, if you look at the old line of how Buffett did that, right, and made a lot of profits, and you look at you know, the government, how they bought up all sorts of debt and bad situations in banks, and how profitable things were, like Bank of America and Merrill and you know, Wachovia and all these other things that were going under that were bought up, and how some of them were in pretty good position many years later because they will be supported by the government, because our government over the last 50 years, nothing fails. You're not allowed to fail. You're a little bit here and there, but that's about it.
And this has a lot of similarities to what Soros did with the pound too. I mean, you've got the potential position here for these kinds of activities from the major players. So all of this definitely playing in. One more last question to you, and that is, we've seen some pretty big collapses here on the crypto side. Granted, I've also seen some pretty big collapses on the stock side from great tech companies that have just absolutely just imploded. You look at Peloton, WeWork that never was able to go. You've got obviously Facebook, which is in dire straits. I think Meta now in dire straits with the losses that they've been encumbering. Likelihood is, how long do they have before their own board starts to recorrect what's happening there? And then you have potentials here in the, you know, digital asset markets. You know, we've got a peg product called USDT, and with USDT playing into this, Andrew, that's Tether. If we were to see something depeg like that, what kind of impact do you think that would have on markets in general? Because that could cross over boundaries.
It could. I mean, there has been a constant, I think, question as to whether or not Tether actually, true Tether, has real backing. It's supposed to be backed, right? 1 for 1, isn't it?
Yep.
So basically what they theoretically did, right? I mean, correct me if I'm wrong, but they digitized the dollar in a way that could be used across platforms, et cetera. That's the whole mechanism of Tether. There's been a lot of questions, though, as to whether they really have the backing, and that's the big issue. I think there was a slight decoupling, didn't it? Crack the dollar.
Yeah, it has had a little bit of a downtrend. It's had it before in the past. It's mostly laden through commercial paper, which is one of the bigger scenarios. It does have dollar backing, but not percentage-wise like a USDC, which is a 1-to-1, either security and or US dollar backing. So there are some variations. That's one of the big concerns in the market right now from at least the digital asset side, is if Tether, because that's pretty much the 800-pound gorilla in crypto right now. It's the number one stable coin globally. USDC and Circle would come in and pretty much sweep the floor, I think, at that time. So it's going to be interesting to see how this all
I don't think that it would have, I mean, I don't know how many people have money in just Tether. Obviously, I see it as more of a conduit, right? You know, because you want to buy something, sell something, move it through there, and then move it to the next place, right? That's, you know, you're buying on platforms, Bitcoin Tether, then I'm selling that, and it's in Tether, and now I'm buying, you know, some kind of Shiba Inu coin or something, or whatever it is, whatever I'm buying, you know, because it could be transferred. And that's why I see it as a cash sweep account mechanism, like you have at Schwab or TD Ameritrade. It's just a temporary place, or somewhere you're just holding on to your money. I don't think it would be that detrimental. I mean, it's bad, but it will not be that detrimental to the main markets unless it feeds over into the crypto space, which I don't know if that would either. It's all about confidence. Right now, confidence is not high in the crypto space. There's really a lot of concern. And the differential, let me just end on this, between a Peloton and crypto, I think in the mind of investors, is that they can really understand the trends and what's happening, the pricing models, inflation, supply chains, what management is doing with the Peloton, right? Good or bad, competition. And, take that compared to a Dogecoin. Explain.
Yeah, well, that would not be a good comparison. I would compare Peloton to like an Ethereum, which would be
so even
an
Ethereum,
emerging, it's a tech that hasn't quite broken loose.
Right.
Yeah.
Right. But I'm saying it's okay. So that's great. So where's the product? That's what people would ask.
Yeah, exactly.
You can
exactly.
go through, right. So it's like, and what's the, where are they making money? Well, it's not really about making money and profitability. It's really about long-term stability of use on the project side and building on top of it and all the back end, blah, blah, blah. Right. The whole thing. Right?
Man, you sound like you're pitching Ethereum right there. See, that's exactly the scenario. So
yeah, exactly. That's the theory. Right. I get it. It's all project based and it's all run on top of, and, we have to figure out a way to get the cost of transaction down on it, obviously, and the energy consumption down on it, and make sure it's stable, et cetera. So, I mean, all I'm saying is that, and there's a lot running on it already, right? There's a lot of projects are built on it. I think the Celsius situation is probably feeding into what's going on.
Yeah, it's driven a lot into staked
NFTs?
ETH, which is, staked ETH is the big culprit because they had so much in there. They couldn't get access to it, obviously, because that's going and leading into ETH 2.0 and their eventual merge to go into that. Hey, listen, we're going to cut this one short, but hey, stick around here. I want to talk to you after the show. I want to jump out of here, guys. Make sure, and thanks so much for watching in today. Of course, we're going to have a lot of lives today for you guys. Obviously, the FOMC is going to be hitting a lot of that cool stuff, so make sure and stick around there. Check out the feeds. That's going to give you some notifications. If you guys have not jumped into the Diamond Circle, make sure we'll leave some links below. It's our free email newsletter that's going to give you insights. It gives you some of our own Power Index data, which we do occasionally. And of course, if you want to reach me, it's out on Twitter @Paul Barron. We'll catch you next time right here on TechPath.